Okay, so let's talk about something that has honestly been blowing my mind lately. You've probably heard that America has a massive debt problem. And yeah, it does. No sugarcoating that. The US national debt has blown past $36 trillion. That works out to roughly $107,000 owed for every single person living in America. When you say that out loud, it almost sounds made up. But here's what I actually want to focus on today. Because while everyone is talking about America's debt problem, China is quietly sitting on a debt situation that is, and I mean this literally, far larger than America's. And the truly wild part is that you will not find it clearly in China's official numbers. The debt is real, it is enormous, but it is buried across layers of their financial system that most people never think to look at. So today, we are doing a proper deep dive. We are going to go through where China's real debt lives, why the official numbers paint a very different picture, and what this means for the global economy. By the time we are done, you are going to see both of these economies in a completely different light. Now, before we jump in, if you are not already subscribed, this is a great moment to do that. We break down big economic stories like this every week, the kind of stuff that actually affects your money and your future. Hit subscribe quickly and let's get into it. Alright, let's start with the surface level numbers. On paper, China actually looks pretty responsible. China's official government debt sits at around 84% of GDP. Compare that to the United States at 123%, or Japan at around 250%, and China seems conservative. You would look at those numbers and think China has things under control. And here is the kicker. China is also one of the biggest buyers of US government debt. They hold hundreds of billions in US Treasury bonds. So by the official scoreboard, China is the lender and America is the borrower. China looks cautious, America looks reckless. Except that picture is almost completely wrong. Here is what most people miss. China's financial system is built very differently. In the US, when the government borrows, it shows up clearly in one national number. You may not like the number, but at least it is visible. In China, a huge portion of government spending happens at the provincial and local level. Imagine if every US state was running massive infrastructure programs, building cities, highways, and rail networks, all funded by debt that never fully showed up in federal figures. China's local governments have accumulated debt equal to roughly 76% of GDP. Add that to the central government's 84%, and you are already looking at around 160% of GDP. Nearly double the official number, but we are still not at the full picture. China has something the US does not have at the same scale: state-owned enterprises, or SOEs. These are companies that operate like businesses but are ultimately controlled by the government. They build infrastructure, develop housing, and fund major projects globally. And they borrow heavily. Estimates put total SOE debt at around $30 trillion. Technically, this is classified as corporate debt. But if these entities run into trouble, the government is expected to step in. So, in reality, that debt is closely tied to the state. When you add everything together, central government debt, local government debt, and SOE debt, China's total debt burden climbs to around or above 300% of GDP. Now here is an important point. These estimates rely on China's official GDP figures. Some independent research suggests the real economy could be 20 to 60% smaller than reported. If that is even partly true, the actual debt ratio could be significantly higher. To be fair, Chinese data is difficult to verify from the outside. There is uncertainty in the exact numbers. But the overall direction is consistent across multiple analyses. Now, here is one of the strangest parts. With all this hidden debt, you would expect China to pay higher interest rates than the US. That is how markets usually work. More risk means higher borrowing costs. But China's 10-year government bond yields are around 1.7%, while the US is paying around 4.5%. China is borrowing more cheaply despite all these underlying risks. The reason comes down to capital controls. In the US, investors can move their money freely. If bonds are not attractive, They can invest in stocks, global markets, or real estate. In China, money cannot move as freely. Investment options are limited to domestic banks, the stock market, or government bonds. And the stock market has not been particularly strong over the long term. So even a low-yielding government bond becomes one of the better options available. Investors are effectively captive. That creates an artificial kind of stability. Now let's look at another important difference. In the US, household consumption drives about 68% of GDP. Globally, the average is around 56%. In China, it is only about 39%. That is unusually low for a developing economy. Something is holding back consumer spending. Part of the answer is those same capital controls and limited investment choices. When people feel restricted, they tend to save more instead of spending. So where does all that savings go? Historically, into real estate. For years, property was seen as the safest way to build wealth in China. As more money flowed in, prices rose dramatically. In cities like Beijing, homes can cost around 35 times the average annual income. That is far higher than cities like London or New York, which typically range between 10 and 15 times income. This created a massive real estate bubble, and that bubble has been slowly deflating. Major developers have struggled under huge debt loads, and many households have most of their savings tied up in property that is no longer rising in value. This ties into another issue, deflation. While much of the world has faced inflation, China has experienced falling prices. That might sound good, but it is actually a warning sign. When prices fall, people delay spending. Businesses earn less and cut back. Demand weakens and growth slows. Deflation also makes debt harder to manage because the real value of that debt increases over time. So how has China financed all of this? A big part of the answer is money creation. China's money supply has expanded dramatically since 2000. State-controlled banks have issued large amounts of credit, funding infrastructure, real estate, and government-linked projects. This has not caused high consumer inflation because much of the money stayed within the financial system rather than flowing into everyday spending. But the risk has not disappeared. It has simply shifted into other areas. Now it is important to be clear. None of this means China is about to collapse. There is a key factor that changes the picture. Unlike many Western governments, China holds significant assets. The government owns land, major companies, utilities, and infrastructure. When economists try to estimate total assets, some conclude that China's government may still have substantial net worth. So while the debt levels are high, there is also real collateral behind them. That does not eliminate the risk, but it does make the situation more complex. Here is the bottom line. China's economic system operates very differently from Western economies. The government controls banks, capital flows, major companies, and large parts of the economy. This gives it powerful tools to manage financial stress. But those same controls come with trade-offs. Consumer spending remains low. Investors have limited options. Real estate becomes a primary savings vehicle. And debt continues to build in ways that are not always transparent. Both the US and China face serious debt challenges. But the risks and how each country handles them are very different. If you found this breakdown useful, make sure to subscribe and turn on notifications. We cover big economic stories like this every week in a way that actually makes sense. Drop a comment below. Do you think China's debt situation is manageable, or is there a bigger problem ahead? And one last thing before you go, check the description below. There are links to resources connected to this channel. Every time you check them out, it helps support what we do here.